Goldline tonight, the premier source for all of your precious metal purchases. And we are excited to be joined by Carol Roth. She is a recovering investment banker. I mean, do you really actually recover? And a two-time New York Times bestselling author, including her most recent book, You Will Own Nothing. Carol is also Goldline's economic pro and brings us exclusive, valuable commentary in her newsletters and her videos. Carol, how are you on this fine evening?
I'm doing very well, Joe. And to answer your question, no, we don't ever recover, which is why I'm in recovery from being an investment banker. It's a 12-step program. I'm always somewhere stuck on step 11, but I am really excited to be with you tonight. I'm excited to be with Goldline and, of course, our wonderful audience, whether they are watching live with us right now or perhaps watching the replay. It has been an interesting day with the Fed. We have another puzzle piece in this ever-changing jigsaw of the economy, but I think we have some really good things to discuss this evening. So excited to do that with you.
Absolutely. And it's always a pleasure to be here, and especially today, because there is so much to discuss, right? And before we delve deeper into the heart of the Fed meeting today, I'd like to take a moment to acknowledge our sponsor, Goldline. For those of you who are not familiar, Goldline has been the go-to source for precious metal purchases for decades. They've crafted a special opportunity exclusively for you tonight, our webinar attendees, but we'll get to the details on that a little bit later on. It's opportunities and insights like this that make these events invaluable. With that in mind, let's move forward and dissect what transpired today in today's Fed meeting and what it means in terms of moving forward. So Carol, a lot went on today. Can you break it down for all of us laymen, please?
Yes. All right. So if you have not been glued to the news on social media or on your TV, one of the good things, there are very few, by the way, one of the good things about the Fed of late is that they really telegraph ahead of time what they're going to do. So it was very much as anticipated. They signaled that they plan to, continue to pause at this meeting. They did not raise rates. This was a unanimous decision, as expected by investors in the market. And so they're leaving rates unchanged at their Fed funds target rate of 5.25% to 5.5% and continuing their balance sheet runoff. Also, as expected, they said they will continue to be data dependent, which means that another hike could be on the table for the next two meetings. There's one the first day of November, it wraps up, and then there's one kind of in mid-December. So that is still on the table. And that was reinforced by probably the only interesting thing that comes out of this meeting in terms of a potential surprise. And that's something called the dot plot. So in layman's terms, that is a chart that records each one of the Fed's officials' projection for where they think the Fed funds rate is going to be at certain periods of time. And not that it's always accurate, but it kind of gives you a sense of what the individual members are thinking. So what we saw was some movement here. We saw that there was potentially by the dots this potential for a hike later this year. And then also the key term you want to take away from this meeting is higher for longer. In the June meeting, they said, okay, 2024, we're probably getting 4 rate cuts. In this meeting, they're saying, well, in 2024, maybe we'll get 2 rate cuts. So it means that they are really less confident about their path in terms of stopping the hiking cycle and then turning that into a cutting cycle. And this is due in part, one of the things we got to see was their economic projections, and they think that the economy is growing at a faster pace than they had previously projected. So that's, part of what had happened there. And then, of course, Jerome Powell acknowledged that fiscal policy is presenting challenges, as he always kind of dances around, but likes to pretend that he's independent and doesn't ever come straight out and tell the government to cut out their spending and to give the Fed a hand. So, as I said, kind of a headline as expected, but that higher for longer piece is what a lot of the market is really focused on, and that's why you saw the market sell off a bit today. And before we came on here, futures were down for tomorrow too.
That's interesting. And given the recent data we've seen, Carol, and now what we're hearing from the Fed, as you just mentioned earlier, noted, what are your biggest concerns about the economy, and where are the bright spots, if any?
How long do we have on this topic, Joe? All right,
Go all
I'll give you
night.
I will give you a little bit of my headline. I think that when it comes to the Fed, that I've always said that they don't necessarily have the tools to fix inflation long term. And I don't think that the correlation is the same as causation. So even though we have seen the inflation rate come down, I don't necessarily think that all of that, or even maybe the majority of that, has been driven by Fed policy, by monetary policy. And we'll talk, I'm sure, a little bit more about that later. But with that backdrop, I have two really big concerns, and these should be concerns on everybody's radar, because I think they're fairly, at least the first one for sure, is not really disputable. So we have done nothing in this country at the government level to fix the outrageous debts and deficits that we have. We have a balance sheet that looks like an emerging market in crisis. And one of the things that I'm very concerned about, that you're hearing a lot of economists talk about, and I'll actually be talking about in my next newsletter for Goldline, is something called fiscal dominance. I don't know, Joe, if you've ever are you familiar with that term? Have you heard that before?
I've heard it, but I need it explained in more detail where I can explain it to my kids.
So fiscal dominance is sort of what it sounds like. It's when the fiscal policy comes to dominate monetary policy that's going on at the same time. In and of itself, that's not really a big deal. But when you put it in the context of where we are today, you've got the monetary policy that's trying to bring down inflation at the same time that you have these huge debt deficits. And normally that would be a signal to stop spending, and they're not. So the concern is, as the Fed is raising rates, that makes it more expensive to finance not only the $33 trillion in existing debt, whatever needs to be rolled over, which I'll talk about in a second, but these huge deficits. It's projected by CNN to be $2 trillion for, well, actually it's the CBO, CNN reported it, but $2 trillion for this fiscal year. So that needs to be financed as well. So when you have these interest rates rising, that means you have, more financing, more interest costs. And that means somehow you're going to have to finance that, which is with more debt. And if you have to eventually print money because there's not enough buyers, or there's just more supply of treasuries in the market, that ends up poking up the rates, and you end up getting into this vicious cycle where the high rates keep stoking inflation and actually doing the opposite of what the Fed's intending. So as I said, I'm going to get into this really deeply in the next Goldline newsletter, but I think it's a very important thing. And if you haven't seen the headline numbers, $7.6 trillion of US government debt needs to be refinanced in the next 12 months. So that means with the rates having moved up so far so fast, that is hundreds of billions of dollars of incremental costs just for interest expense alone. So I don't think that enough is being paid, enough attention is being paid to that, and this is a long-term problem for the economy. The other side, before I get to the bright spots, is that the energy policy hasn't been fixed, right? That we have this administration, and we have a whole bunch of cheerleaders that are trying to move us towards this green future. And that not only threatens inflation directly, because as we're seeing the price of energy creep up, it affects your gas, it affects your energy bill in your house, and also everything else, all the derivative products through the economy that depend on oil. But it also threatens the role of the dollar. And that's because we have oil that is priced in dollars around the world. And now we're saying, oh, well, we want to be green. And so countries that are focused on oil are trying to move away from that. And that also, the potential movement away from the dollar pushed by this green policy could also stoke inflation. So those are really the two areas that I think are the biggest concerns. People, Joe, by the way, you spend a lot of time with me. People sometimes accuse me of being a downer. So I'm going to give you some bright spots tonight, okay? There are actually some good things that are going on in the economy. One is obviously the employment situation. We do not have mass unemployment. In fact, we have very low unemployment. which, by the way, is very strange at a time when you have the high deficits that we have, which kind of shows what a mess we're in. But nonetheless, that is a bright spot. The second one is kind of a meh bright spot, but it's still bright, so we'll go for it, which is that we are the cleanest shirt in the laundry. And you may have heard that phrase before, but despite all of our woes, it's not like there are all these other big superpower countries that are doing well around the world. So that gives us a little bit of breathing space, not an infinite amount, but it is a reality. And to the extent that there is some sort of a global geopolitical or economic issue, or even a domestic one, it still means that when there's a flight to safety, it's probably still to the US Treasury market, despite everything that's gone on. And so the Treasury market's likely the beneficiary of something like that. That would be good for yields and still puts us in a pole position. And then the stock market, right? The stock market has held up extraordinarily well, given the fact that we've had this huge whipsaw from zero interest rate policy to 5.25% to 5.5% in such a short period of time. I mean, this is historic. So the fact that the markets have held up so far, I do think we have to give props to and say that that's a bright spot.
Wow, it's a lot to unpack. I want to go back to one thing you talked about before, Carol, in terms of, and you've talked about this on Fox and in the radio spots that we've done together, about the massive intervention by the Fed and how it's really distorted the market, right? And how does that play into what we're discussing tonight?
Yeah, I'm really glad that you brought that piece up, Joe, because I don't think it really gets enough attention. Sometimes we forget because we're in the middle of it. We have had 15 years of massive Fed intervention, almost $9 trillion that was put on their balance sheet over that period of time. Over that almost 15 years, most of that was, near zero interest rate, or some of that was near zero interest rate policy. 9 of those years was at what's called ZIRP, zero interest rate policy. This is an experiment that we haven't seen before. So when you look at a normal Fed tightening cycle, anytime they shift monetary policy, and again, it hasn't been as severe as we've seen, before, but at any time that you do it, it's going to take about 12 to 18 months for that to cycle through the economy. The difference here is that we're coming from a time of 15 years where businesses and consumers had access to cheap available debt, tons of it, and they loaded up on it. So with the length of their intervention, with the scope of their intervention, I don't really think that we have begun to see the impact of what the Fed has done throughout the totality of the economy. Certainly, we've seen it in areas, like banking. It's, created some issues there. But in terms of it fully working its way throughout the economy, I mean, it could be another 3, 6, 9 months before we really start to see the outcome of that because of this sort of historic level and scope of the intervention.
Carol, that impact, if you had to bet, would it be more negative or positive given all the manipulation?
The impact, I mean, I think it's going to be negative because you're going to have to pay the price. And I don't think that we have fully paid the price for that because it really hasn't worked its way through. People, businesses, they have the debt. If you load it up on that and you've locked in a certain rate, then your cost of capital for now is cheaper. Then all of a sudden you run out of all that debt that you've locked in as a business. And now you have to go and you have to look at debt that's, hundreds and hundreds of basis points higher, things that we haven't seen in a decade and a half. And what does that mean? If you have a higher cost of capital, that means the businesses are going to be pulling back on investing. They may be laying off people. And that sort of, obviously trickles through the economy in a pretty serious way.
I should have couched that as a rhetorical question, but duly noted, and I appreciate that feedback.
I like to explain everything, so.
It's like listening to a professor at the University of Chicago, and I appreciate that. Now, we know that the consumer drives a huge part of the economy, right? I mean, in the end, it comes down to consumers. But Jamie Dimon, he issued this warning recently, and I have the quote here, saying, quote, "Huge mistake to think an economy will boom with so many risks out there," unquote. So what is your take on that statement by Jamie, and how does that impact what's ahead?
Well, as you probably know, I do have a lot of respect for Jamie Dimon. He's an incredibly smart person. We don't necessarily agree on everything, but as the head of a major bank, he's got a lot of insight into the consumer. So he's seeing data and trends in a way that, you and I might not see them. However, in this particular case, we actually don't need to be Jamie Dimon to see some of the trends. The consumer, as we know, is about 70% of the economy. So what is happening to the consumer is very, very relevant to what's happening in the overall economy. One of the things that we know, which Powell actually reiterated today, is when you're looking at personal balance sheets of households on the asset side, the personal saving rate, the amount of the income that's being saved, is very low. It's below historic averages. That is at 3.5%. That has come down dramatically. So people are saving less of their income. When you're looking at the other side, the liability side, the debt side of the consumer balance sheet, that's an even worse situation. They are incredibly ugly. We are having record household debt, $17.1 trillion in household debt, which is a record. And we know it's a record all across the board. It's a record in mortgages, a record in autos, a record in student loans, and a record in credit card debts. I also saw a note from the Kobayashi letter that the average payment for mortgages is going to hit $3,000 a month for the first time in history. And so these kinds of things, especially, as we see mortgage rates continue to rise, the rate on credit cards is 25%. I mean, I can't even fathom that. So we're seeing more defaults on autos, more defaults on credit cards, things that we haven't seen or levels that we haven't seen in about 10 years. We know that student debt repayment is days away from those payments kicking in and becoming due again. So from a balance sheet standpoint, the consumer has been hanging in there. They've been spending, but at the expense of their personal balance sheet, quite literally. Now, why are they doing this? I mean, one is obviously they're trying to mitigate through inflation. But as we said, from a wage situation and from a job situation, although wages, have ticked up a bit, they haven't quite fully caught up for families, but people have jobs. And when they feel confident about having the jobs, they're more likely to spend. Now, with that said, some of the data that we're seeing of late in the jobs market is showing a little bit of softening. And Powell acknowledged that again today, too. So we have fewer jobs that are open. We have fewer people who are quitting or leaving their job, which signals that people don't feel confident in leaving one job behind and finding another. The overall number of jobs being created month to month is going down. And oh, by the way, every time they report them, they're being revised down as well. I'm sure you've noticed that, yes. So anecdotally, I don't know what you're hearing, Joe, but one of the things that I'm hearing about more layoffs across a lot of different sectors. If before it was, tech was over hiring, now I'm seeing that start to spread out. So it does feel a little bit like a storm is brewing. I don't think that means that we're getting back up to, double digit unemployment, but, that could change the trajectory of the consumer. The crazy thing, and this is, I think, one of the big takeaways here, is because there are so many things that are different and historic and broken right now, is it doesn't guarantee a certain outcome. I mean, normally if you say, okay, well, the consumer, boy, they're facing all of these headwinds, and what happens if the job market cracks a little bit? Does that mean we hit a recession? Well, not necessarily, because we just told you that the government is spending like a drunken sailor, with no disrespect meant to drunken sailors. So they're adding a lot to what we're talking about here. So that doesn't guarantee that. And then the same thing on the inflation front. You would think that, if the consumer rolls over, the job market rolls over, well, that in itself would bring down inflation. But what the discussion we had before about, the sticky debt deficit situation and how that might drive inflation, that doesn't mean we're going to get the guaranteed outcome as well. So we really do need to be prepared for a lot of different situations, which I'm sure we'll get into more.
You talked about mortgages and them being at record levels, and then you hear about all this consumer debt as far as credit cards. Why isn't this a preview of 2008 all over again?
It's a really good question. I think part of that is the tightness in the labor market, right? That if we didn't have the supply demand imbalances that were really, there was already kind of an issue before COVID, but COVID, the policy decisions made there just completely exacerbated that. And so we really haven't seen that. We've seen it shift a little bit, but it hasn't fully sorted its way out. And so I think that's part of what saves us. In addition, on the individual housing front, it doesn't seem like the single family housing front, it doesn't seem like we have the crazy derivative scenario that's going to topple the market and make some thing that might be bad exponentially worse. Doesn't mean it can't happen. It's an outlier, a possibility, but right now it's not looking like a probability.
Okay, that's good to hear. And I want to bring in, forget my questions. I want to bring in some of the questions we've received into the conversation since we started. First, we have some questions on your predictions, Carol, for the Fed. First question, do you think the Fed will continue to raise rates to combat inflation?
I think this is a good question. I think that they have signaled, as we talked about before, that there's an intention that they are going to potentially raise rates. Some, they might raise, once again, at least, depending on the data. But if we're just in the same data situation we're in today, either at one of the next two meetings. So I do think that it is a possibility that they are going to continue to raise. The question is, how long does that go out? How long do they hold that? And then when does that turn around and turn into a cutting situation?
Second question, will the Fed keep raising rates until they reach their 2% target, which seems like a high aspiration?
So that is, it's a high-low aspiration, I think, Joe. I think that they have already signaled that they want to get, quote unquote, close to 2%, but they may not be able to get back there for quite a long time. I think that they are going to probably be in a position where they either declare victory or they declare that they have as much victory as they can do with policy and then move on well before we see 2%. And we saw that in the summary of economic projections, the SEP that came out in association with the meeting today. It doesn't happen in every meeting, but this was an SEP meeting. They don't expect to get back to 2% on the PCE, which is the measure of inflation. There are about three different measures that they focus on, and that's the one that the Fed is really focused on versus the CPI, which I think is the one that the media and most of us are always focused on. But they don't think, based on their own projections that they put out today at the meeting, they don't see getting back to 2% inflation until 2026.
Wow.
But at the same time, we start seeing on their dot plot rate cuts in 2024. So what does that tell you? That they, do think that they're going to start a cutting cycle, at least based on what they're projecting today, well before we get to that. I will also throw out there that, as we talked about, there are all these different issues that are putting upward pressure on inflation, that, deficit and financial printing I was talking about earlier. if that's the case, if we do end up in this fiscal dominance cycle, we're going to want the Fed to stop raising, because it would actually be advantageous for them to lower rates if that's part of what's contributing to this inflation outlook. But on the other side of that, you have energy. And, last winter, the world had a very mild winter, which is a gift. This is not a strategy. So assuming if we were to, walk into a very cold winter, either here in the US or in Europe this year, that means that the cost of energy is probably going like way up, maybe back to the levels that we saw last year or worse. And that's going to put an awful lot of pressure on the Fed to continue to raise rates. So I think that's going to be something else that we need to look at. And they're sort of just these outside factors, and these sort of Fed rate questions about what's happening in the Treasury market and kind of the intricacies there that could be a complete wild card. So that's the best prediction I can give you on what they're going to do and the levels based on the scope of what's going on.
Okay, all I know, Carol, is that my kids were so angry that it snowed once here in New Jersey, basically in December. It never happened again. They just want to go sleigh riding, and it was all mud the entire winter. We didn't mind.
Tell them to wait 20 years, and they won't be saying that anymore.
Or to move to Chicago, where you are. Then snow is not a problem. Anyway, we received a ton of questions related to the dollar's status and the global financial order. So here's the question: what is the probability of the U.S. dollar losing revenue currency status?
Reserve currency status?
Yeah. Sorry, okay. Reserve currency status.
Yes. So, this is like the multi-trillion dollar question. And I think, one of those that is getting some airplay, but perhaps not in the right way. So what people need to understand is that on the global stage, the dollar plays in really two arenas when being sort of the center of the global financial universe, if you will. One is the reserves that are held with central bank, but the other one is in trading. So on the reserve front, we already know that central banks have been lightening up on reserves. The percentage of U.S. reserves has been accelerating or decelerating, I should say, in a way that we haven't seen like in a very long time. And what's interesting to me, Joe, is that they're not replacing those reserves at the central banks with other currencies. They're actually replacing them with gold. And I think this is going to be a focal point of some of the rest of our discussion. But clearly, as there is this distrust of fiat and concerns about it, around the world, these central banks are saying, "Look, if I'm going to get rid of dollars, I'm not going to depend on something else. I'm going to depend on something that I know is a solid store of value." And they've been showing that by loading up on gold and using that to replace their treasury. So, that's kind of one piece of it. The other piece, as I mentioned, is the trade piece. And right now, the dollar, like far and away, dominates trade. Like it's on one side, at least of every transaction, of like 85 to 90% of the transactions that happen globally. So From that standpoint, it's very well entrenched. So I don't think that the dollar is going away, very soon. I don't think that another currency is coming out and replacing it. What I do think is happening and is going to continue to happen, and this is what is underappreciated, is that there's just a further degradation in both of those positions. Obviously, the reserve side, we can see that already happening. We're seeing, we've obviously seen it in places like China, but we're seeing it in Saudi Arabia now, places that we hadn't seen it before. So, that's a trend to continue to watch. But the degradation in trade is really one of the things that the BRICS countries are focused on. They're trying to do more trade without having to convert to US dollars. And if there is this degradation and further degradation in one or both of these, it's going to create a higher cost environment from the US. And I think this is what's not appreciated, is it doesn't need to go away. It just needs to be a degradation in order for it to have an impact, especially when the US is used to having cheap and available financing from the dollar being the reserve currency. So it's not like I'm seeing hyperinflation as a most likely outcome. But if we have long-term, sticky, elevated inflation, even at like a 3 or 4% rate a year, that's the kind of thing that just slowly eats away at the wealth of the middle class. And so it may not sound, that bad for a year or two, but it compounds just like anything else. And that is the real most probable risk that I don't think people are paying enough attention to. And by the way, it's why hard assets and having hedges in hard assets, including precious metals like gold and silver, is so critically important.
Okay, so speaking of the BRICS, and I've read about this, they've discussed this idea of a new world currency partly backed by gold. So I guess two questions. I'll give you the first, you answer, and we'll go to the second. I know you've written about this and done videos on this recently. For everyone here, what are the implications, especially with Saudi Arabia set to join?
Yeah, so, I think just to reset the room here a little, I know I've mentioned BRICS already, but let me just explain what they are. It was really a concept that came from a Goldman Sachs research report that ended up being put into practice. But it's these formerly emerging but very powerful nations. So it stands for Brazil, Russia, India, China, and South Africa. That was the last to join. And they want to give themselves more of a voice in what's going on in the world. And they have a really substantial part of the world's population. And what we saw, they had a meeting last month, in August, and this is something I actually wrote about in a previous Goldline newsletter and did a video on as well. But they basically said that they were going to expand their membership and frankly, more than double it. So in addition to those countries I just mentioned, they've now extended invites to Saudi Arabia, the UAE, Iran. Those are the biggies. And then Ethiopia, Iran, Egypt, and Argentina. I know, strange bedfellows, right? But, let's talk about why all of these groups are mad and what it is that they have in common. So with China, obviously they want to flex power. They want to challenge the US. That's something that's been going on forever. But it's underappreciated how vulnerable they are to changes in the dollar. They are net importers of energy as well as food. And when those are commodities that are priced in dollars, they are very vulnerable to shifts in the US dollar. So if they can move away from that volatility, that's something that they're going to want to do. Now, obviously, that's very different than Russia, who was on the end of the Biden administration's weaponization of the dollar. After Russia invaded Ukraine, they got together with some of our other allies and said, guess what? You can't have access to your reserves. Well, if you're the world's reserve currency and you can weaponize the dollar, as a policy maneuver and tell people you can't have access to reserves when we tell you can't access, that gives countries a reason to want to move away from the dollar being the world's reserve currency. So that's understandable there too. And as I alluded to in the beginning of our discussion, the Saudis, they're worried about the green energy push. I mean, this is the backbone of their economy is oil and energy. Oh, yeah. So you have, the US and their allied partners wanting to move away. And then you have China who's doubling down on it. So, if China says, I don't want you to price this in dollars, and that they're going to be your customer and everyone else is trying to put you out of business, I think that creates some reasons to want to move away. So, those things are kind of, all coming together. Right now, it was speculated that they might bring out an alternative currency during that meeting. They didn't, but they want to do more trade in their local currencies. Now, what's the problem with that? The problem is that a lot of those currencies aren't trustworthy. And so what have they done? As I said, they've been loading up on gold, and particularly China. China has been buying and buying and buying, and they're using that not to fully back their currencies. It's not like a one-to-one backing like when we were on the gold standard, but as a credible means of settlement for trade. And so I call it sort of like a loosely backed, a pseudo backing for these other currencies. And, I think that, that's something we really need to key into, that as the global financial order continues to shift, and those things I talked about, those are real concerns that I don't think are going to be solved, certainly not in this administration, but maybe even not if we have a new administration. I do think that there's a very strong possibility that gold plays a very important role in whatever either currency or settlement system is developed. And, while that's great for gold, it's not necessarily good for the US's fiscal role and the outcomes that we're going to be seeing. So, kind of two reasons why you might want to consider a hedge there.
That's interesting. You talked about all those countries that may want to join BRICS. It sounds like the Major League Baseball playoffs. Like, everybody gets in at this point, including my Cubs and your Cubs, I would imagine.
It's
yes.
the crazy thing is it's actually in the Major League Baseball, everyone's getting in. They had like dozens and dozens and dozens of other countries that actually applied for membership. So this was the exclusive group that they picked. So it's more exclusive than you would think, Joe.
That's interesting. Okay, so what would happen to the price of gold considering, it's limited above ground supply? I mean, there's only so much to go around.
Yeah, I mean, obviously, I always hate to speculate on specific prices over specific time, but I do think that there are a lot of theses given the fact that, gold is limited in supply. And, we have seen more and more about that, and there's more demand for that. I think the normal supply demand relationships are very meaningful. And one of the things that you could see, if the BRICS really want to dig in, is they could themselves, basically reprice what gold is. And that would, obviously set off a chain of events. So I think, overall, it sounds quite bullish for gold. But, if I could tell you the exact price and the exact date, I'd be on my yacht in the Mediterranean and not having this wonderful conversation with you, Joe.
On a beach earning 20% to quote Hans Gruber in Die Hard. All right. So another set of questions relate to concerns about CBDCs, which sounds like a bad club back in the 80s on the west side of New York. But I believe that's what the central bank digital currencies, correct?
Correct.
Am I right on that? All right, good.
That
I did
is
my
correct.
homework.
Very, very, yes, you did a very good job with that.
Thank you. So considering the Fed is, actively working on digitizing the dollar, literally as we speak, how might owning physical gold and silver benefit me or you or anybody listening right now?
Yeah, so CBDCs are very much a wild card. And I would say from a sort of, non-economy standpoint, but just, kind of a broader macro standpoint, the thing that I am the most worried about, because this, would be the end of our freedom. So if you don't know what a central bank digital currency is, it is a digital form factor of whatever currency the central bank and government, issues. And obviously in our case, it's the US dollar. But what it is it's fully centralized, which makes it fully transparent. And by the way, also fully programmable by them, because it is a digital asset and it's not, something in a form factor. So imagine that your credit card had a microchip in it, or even your dollars had microchips in it that were fully transparent and monitored by the Federal Reserve and the government. And whatever you wanted to do, they would have the ability to weigh in on whether you could do it or not. They could make your money expire, or they could give people incentives that expire or only are used in certain places. The really, kind of worst case scenario is they want to push a green agenda, for example, and they say, Carol, you've eaten too many burgers this month. I go to try and buy another burger and they just completely cut me off. Or, Joe, I see you've been hanging out with Carol and she's kind of, suspect. So we're just going to cut off access to your money for a while. And that is the real danger here. They're trying to make it sound like decentralized cryptocurrency. And it's exactly the opposite. While it's a digital form factor, it's entirely centralized and entirely controlled. We've seen what some control by the Fed and the government has done to our money. This would be the absolute worst thing that could ever happen. I cannot reiterate that enough.
That's
so
interesting.
When I think about, how do you hedge against that, right? Like, how do you make sure that you have something that, is in your own control? Like, what could you possibly put your money in that's going to hedge against that? The ultimate anti-CBDC hedge right now is physical precious metals, gold and silver. This is where you look. You have to look in that direction, because if you're looking for, a store of value or a medium of exchange, you have to have something that you can control, that they haven't digitized, that they don't have access to. And so to me, that really stands out at the forefront.
Centralized and capitalism don't really go together. That makes complete sense.
No.
It's his bumper sticker at this point. Carol, we received a number of questions related to the banking outlook, headwinds in that sector. One said, and I'm quoting here, I heard Kyle Bass on TV last week saying the U.S. banking industry will lose hundreds of billions, that's with a B, billions of dollars from exposure to the office market, unquote. This is one of several real estate questions that we received. So what's your take, and how does it affect banks, real estate investors, and the economy at large and in general?
Yeah, I mean, there's no doubt that the banking system is still on edge. I think the Fed has done a lot of things to try to stabilize it. They've had these programs where they go in and they're backstopping these treasuries that have lost a lot of value. But, they can't account for everything. And I do think in the commercial real estate sector, particularly as was noted in the question, that office piece of it, there is still a lot of fallout to be had. We still don't have people going back to work. The occupancy rates are down. You have these crazy increased costs of refinancing, and regional banks do have a lot of exposure. So some of them, but that's, when you look at like who's more at risk, the big banks or the regional banks, it certainly is the regional banks. Yeah. So what's going to happen? Janet Yellen warned of future bank quote unquote mergers, forced mergers. I do think that we're not out of the woods on that yet. And, depending on how that is presented, that could create some more panic and shake confidence in the system. There's been just too much that's gone on for too long that, as I said, has really kind of fully worked its way through. The Fed's done more than they probably should have to stabilize this. So, I think it's still a real headwind.
All right, so let me piggyback on that. There's this environment, unstable banking system is the way you described it. How detrimental will, if rates do happen, if rate hikes do happen, further hikes do happen, how detrimental will they be?
So this is probably like, talk about things that you can talk about at cocktail parties with people who care about the economy. One of the weirdest things that has happened when you, and I talk about this, by the way, in my next Goldline newsletter. So if you want to get a deeper dive, you can get all the specifics on this. But, what is tighter monetary policy supposed to do, right? When they raise interest rates, they're shrinking the balance sheets via QT. The whole point of that is to, slow things down, including slowing down lending, bank lending. Now, one of the economic commentators that I follow, who I like a lot, is a gentleman by the name of Luke Groman. He is with FFTT LLC. And one of the things that he explored in a recent piece is that sort of the opposite pattern is happening. He quoted another economist that looked at the 4 weeks that were leading up to the middle of August report on bank loans. And while you think that these rising interest rates would say, okay, well, we're not going to lend, that's what they're supposed to do, they actually expanded slightly faster than the rate during the 2018 to 2019 period, the pre-COVID period. So, like, why would lending be picking up in a cycle where they're supposed to be tightening? Are they just disregarding things the same way that the government is, right? So Luke Rahman also talked to this hedge fund manager from who used to work in emerging markets. And he had noted this as a phenomenon, is that when you get these massive rate hikes after inflation, and basically you have these banks that have loans on their balance sheet at very low interest rates. And so as rates go up, they're like, well, to make our balance sheets look better, we should just put out a lot of loans at these higher rates so that our average rates move up. And so what is happening is that the rates, instead of choking off that lending, have actually been expanding the lending, which is just crazy. Now, obviously, again, that's probably not a long-term thing, it's a short-term phenomenon, but again, goes to the point that what the Fed has been doing really hasn't made its way through the economy, even to the banks, which we know have had some fallout. So, the banks have been trying to shore up their balance sheets. They have been leaning on the Fed, but we have had this, crazy cycle and duration of intervention. So again, I don't know that the Fed can save everything, and it's definitely something to watch.
Wow. Well, Ambien's in my future tonight because I'm pretty sure I'm not going to sleep well, given the descriptions I've heard so far.
I gave you some bright spots, Joe. Remember, I gave you three. I gave you three bright spots. So.
That's true. I think the 3 is losing right now to the other team, but still, thank you for that. We appreciate it. Given that today's webinar is brought to viewers by Goldline, and they are your own personal source for precious metals, tell us why we hear so much about the need to own gold and silver.
So we've talked about a range of things today. Some of them are probabilities, pretty likely that they would occur. And some of them are possibilities. Some of them are remote possibilities. So it's sort of a range of different things that could possibly happen, a range of outcomes. So when you have something that is maybe a lower probability, but it has a really high cost associated with it, if it comes true, what do? You insure for those situations, right? So think about a fire, right? You don't think your house is going to burn down. Statistically, it's not likely. But if it happens, it would be financially and otherwise devastating to you. So you insure for that. And you insure in other areas of your life, right? Whether it's life insurance or auto or whatnot. That is the mechanism. So the same thing with your portfolio, right? There are probabilities where your insurance may come just from you having some diversification, but then there are these possibilities that are very, very significant. And for those, I think that's why you want to have insurance. And I do think that as you consider the different types of insurance that you can have, having physical gold and silver as part of that strategy makes a lot of sense.
Good stuff. And by the way, Goldline is offering a fantastic way to diversify your portfolio. For this live event, they're offering a special for attendees. With every 1 full ounce total of fractional American Eagle gold coins you purchase, you'll receive 1/10 ounce St. Helena Truth Series Platinum coin absolutely free, plus 5 Betsy Ross Freedom rounds in copper designed by Carol. Wow, for free. You're a designer now, Carol. Did not know this.
Yeah, you've never seen them. They actually turned out amazing. Like if you stand for freedom and you're looking for, a really cool coin, I'm really pleased that Goldline let me design this. I'm very happy with the way they turned out.
All right. I figure you outsourced to somebody on that, but no, you did it yourself. So that's good stuff. So again, with every full ounce of fractional American Eagle, gold coins you purchase, you will receive 1/10 ounce St. Helena Truth Series Platinum plus 5 Betsy Ross Freedom rounds in copper for free. So it's a wonderful way to get started and adding to your existing portfolio. You can also see the full details by clicking the link, the description below in the box below this video. So click the link, description below in the box below this video. So all good stuff. So as a follow-up, should one buy gold and silver right now, Carol? Is this the time to buy, or do we wait for fluctuations and so on?
Yeah, well, when you're thinking about do you want gold and do you want silver? Do you want one or the other? I think it really depends on your use case. So I can speak, to my own scenario. So, why do I go after gold and silver and put that in my portfolio? Well, my personal use case is things going really badly, right? It's that CBDC hedge. It is the shifting financial order, probably not the zombie apocalypse, but I won't rule it out, whatever it is, but things really moving in a bad case. And when I think about that, I'm thinking, what's my good store of value and what's my medium of exchange? And I think on the store of value front, that both gold and silver fit that really well. And also for the medium of exchange, I think that's where you're definitely going to want to have silver and gold, and you're going to want to have, different amounts. You might want to have some rounds on the gold side. You might want some fractional coins and rounds, because if you're going to use that as a medium of exchange, if you're cut off, from a system temporarily, nobody's making change for you, Joe.
Yeah.
So you want to have sort of a different array. And I think that this, is a great way, when I work with Goldline, I talk to my account representative and we kind of go through, here are my different use cases to find, which are sort of the best assortment of metals for that particular purchase, to be able to double down on.
It just seems so safe. It always seems so safe. You never hear about, oh my God, I invested in gold and now I have 3 mortgages type of thing. It just seems like a very, very safe bet. So given
let me just, if I can just respond to that, obviously the past can't predict the future, but it does give us data points. So when you look at precious metals, something like gold has a 5,000 plus year social contract. And
wow.
It has other uses as well. And the value of everything depends on a social contract. So that's a good data point. And also, as we talked about, central banks, as they're changing up their reserves, where is their flight to safety right now? It's also in gold. So, it doesn't guarantee anything, but it does give some really good data points along the way.
All right, that's good to know. And given all you've talked about now, Carol, how should individuals be thinking about their portfolios for the rest of the year? What about 2024? We're obviously going to an election year. Sometimes that impacts markets and investments and how they perform.
No, that's a good question. So I think there are a lot of signs, as we've talked about, that point to sticky inflation being with us for longer periods of times. And we talked about just a slew of different outcomes that could happen based on sort of domestic and international geopolitical trends. So in the short term, something you might want to consider: exposure to commodities. If you have cash that's sitting around, look at something like a short duration treasury, whether it's 1 month or 6 months. You're getting like 5.5 to 5.4%, whatever it is. May not perfectly keep up with inflation, real inflation, out what's reported, but you shouldn't be having money that's just sitting there doing nothing. So I would be certainly thinking about that in sort of the short term. When you look at longer term, diversification, I cannot reiterate this enough, is really, really key. I think, more so than just your traditional 60-40 portfolio. I think hard assets are a critical component of that for diversification and hedging. And in that, hedging piece, you should be considering physical, and I have to emphasize physical gold and silver, because with anything that's in sort of the paper market, there's a lot of counterparty risk. And if some of these worst case scenarios happen, they may not actually even have that gold. They have to go out and buy it. And so this could completely send that market into a tizzy. So you want to have something in that form factor you can control. And if you have questions about it, that's when you go and you call an account executive at Goldline. That's what they're known for. They're very high touch service. 800-319-9533. But if you don't have a pen, I know the number and all the information will remain as a link in the description box under the video we're talking about here. But you want to talk to an experienced account executive who can guide you through the different options that are really tailored to your personal objectives.
I like how you have the phone number just memorized. That was impressive. Everybody dials with a phone now. You press a button, to have the number memorized.
You know what?
That's
I don't do that. I actually dial people's phone numbers directly because I don't want to depend on technology. I don't want technology to make me a Borg. So I try to remember everything I can.
That's smart.
And do it physically.
And mine is mine's 8675309. Just want to say, ask for Jenny.
You and Jenny. Yes,
she'll get her to me. So in your opinion, what does a healthy portfolio look like, and what diversifications and what kind of percentages? I know that you can't get exact, but what would you say a healthy portfolio looks like?
So, this is where, by the way, this is where, like, legally they don't let you say things, and then they get mad at you if you give specific financial advice. But It really is very difficult to say because it depends on your age. It depends on your risk profile. What are your objectives? What does your portfolio look like today? And so it's why you should work with both your financial planner and an account executive to kind of figure out what makes sense based on your objectives. Now, generally speaking, as I said, I think that broader exposure makes a lot of sense now. One thing I do want to point out is, from an age basis, if you are younger, if you are someone like you, Joe, who's, barely a teenager at this point, you have a long duration. So you may be able to wait out cycles in the market. But if you're somebody who is going to retire in the next few years, or maybe you are retired, you don't have the ability to absorb that volatility. I mean, we saw this in the Great Recession financial crisis, right? The people who thought they were going to retire saw that pushed out, 3 to 10 years or more because, they were all ready to go. And then your fortunes changed so quickly. So you want to be focused if you're at that older age and you're considering a retirement, or you're retired. You want to be really focused on capital preservation right now because there could be a lot of short and midterm volatility. So you should really talk to your financial advisor about that and make sure you have the appropriate focus in terms of what your risk exposure is. In terms of alternatives, alternatives are typically a smaller slice of a portfolio. And when we talk about hedges like gold and silver, remember we talked about it being a function like insurance. So when you think about insurance, you don't insure at 50% value, right? Most people don't. You insure, for something like gold or silver in a portfolio. A lot of economists and experts and investors say about 5 to 10% of your portfolio is kind of the level of insurance you would want to be thinking about. Now, obviously, again, depends on your situation. It depends on if things shift, because things could change in a very different way that might make that, need to go up. But I think it gives people a really good benchmark to start from and to customize based on their objectives from.
Wow. Well, we've had a lot of great information brought to the forefront tonight to help everyone here and inform everyone here about what might be ahead and how to think about navigating these uncertain times. That's the only way to describe them, uncertain. So before we wrap up with your final thoughts, let me recap an incredible offer from Goldline, our trusted partner for today's webinar. For attendees looking to diversify, remember this special. With every 1 full ounce total of fractional American Eagle gold coins you purchase, you'll receive 1/1/10 ounce St. Helena Truth Series platinum coin plus 5 Betsy Ross Freedom rounds in copper and designed by Carol, absolutely free. And don't forget, Goldline boasts an exclusive collection of precious metals, including unique and highly sought after products. If you've been pondering about diving into the world of gold and silver, now is the time. Call Goldline. Carol gave the number. I wrote it down, 800-319-9533, to explore their exclusive and extensive offerings and to diversify your portfolio. Their phone number and the special offer details are noted in the description below. So with that, Carol, give us your final thoughts. Bring us home.
Yeah, so you called it uncertain times. I think that my, the economic term is, it's really weird, Joe. It's really weird times.
Weird times. Okay.
Yeah, I mean, we have a country that has the balance sheet of an emerging market in crisis. No plans to stop spending, and they also have the reserve currency backstopping it. So you have that kind of teetering. You have global forces around the world who are looking for more power and more dominance and trying to attack the US's position. And this is all on the back of US's self-inflicted issues and weakness. We have the consequences, which, as I mentioned, I don't think we've fully seen, from 15 years of extensive historic Fed intervention. In the backdrop, we have things like central bank digital currencies as a threat. And we have a bunch of countries who are all in really bad situations all one time, with balance sheets, with their economies, in some cases, the movement away from energy, with demographics. Think about what's happening demographically, not just in Europe, but in China and Japan. Yeah. So, there's a lot going on, guys. And so what I want to tell you is things are going to change, right? They're going to change day to day, week to week, month to month. And you want to stay on top of these things because it's kind of like a decision tree, right? Like you start in this space where we are right now. But if this set of things happen, it may take you down this branch. But if these other set of things happen, it may take you down this branch. And that's going to create a whole new set of things that we need to think about. So, if you want to make sure that you stay informed, I'm doing the newsletters and I'm doing the videos with Goldline. They're very committed to keeping you on top of that important information. So we're going to do our best to keep you updated. So with that, I do want to thank Goldline, who, as you mentioned, is my only source for precious metals, and just remind you with this backdrop how critical it is to have these hedges in place for capital preservation. They're insurance. And you don't buy insurance for your house, once it's burning down. You want to make sure that you have a plan in place for that. So plan now. If you've not had a chance to hedge your portfolio, you haven't hedged enough, call my friends at Goldline, talk to one of their account executives. They are so knowledgeable and they're going to be able to help you figure out what is the right hedge for your objective. And since we love the phone number, 800-319-9533. So again, make sure to do that and to check out my newsletters and videos for more information. And with that, Joe, I just want to thank you for the fantastic hosting job and the assistance in sharing the knowledge tonight. You're great. Everybody should check you out on Fox News. Check out your best-selling book, Come On Man, and appreciate you helping me get this really critical information out in a way that I hope was digestible for the audience.
Oh, Carol, the pleasure is all on this side of the table. Believe me, a very educational hour. And really, I learned a lot, and I hope everybody out there did as well. I mean, that was credible, well-informed. And you explained it in such a way that even a guy like me can understand. So thank you for that. And let's do it again sometime.